This is the Seller Process Podcast, where we talk about the best systems, processes, and SOPs for your Amazon business so that you can regain control of your time, build up your team, and scale your e-com empire.
Hello, entrepreneurs. Welcome to the second part of the 3-episode mini-series about crafting your perfect exit strategy. So make sure you listen to or watch the first part before jumping into this one, as we're doing the breakdown of a huge system focusing on one part in each episode. Okay, so to continue our discussion is once again with us Scott Deetz, the founder and CEO of Northbound Group, a leading strategic finance, corporate development, and sell-side M&A advisory firm focused on Amazon and e-commerce physical goods and SaaS businesses. Northbound has more than 30 full-time team members dedicated to the mission of helping e-commerce entrepreneurs achieve life-changing events. Welcome again, Scott.
Thank you, Gianmarco. Good to be back.
All right, so we're back here with the second episode. So we're now going to discuss the second phase. In phase one, we cover the vision and goal. So how the awareness part, the way I call it. So basically being aware of what's going to be the number that we want to achieve, the vision that we have for the company, the goal. So we covered how to set the goals, how to envision that number. So now it's time to understand what the current value of our company is and plan how to get there. So again, give us a general overview of the steps that we will cover today, and then we will go deeper into each one.
Yeah, so what we want to cover today, now that we have the owner perspective identified and you know what the target is, the way I always like to think about it is if I'm driving to San Francisco, if I'm in the United States and I'm in Minneapolis, I first have to understand where I'm driving to. That's what we covered in phase one. And then the second one is we have to understand where are we at today, and then we draw the map between the two places of where I am today and where I want to go. So understanding what your business, we're going to talk a little bit about how your business is valued. And there's what I would call a simplistic view of it. And then there's a more advanced view. And I'm going to cover both of them because I think it's really important that you understand them while recognizing that some sellers may be just beginning and maybe the advanced view of it isn't quite as important right now, but will get more important as you get more into your business. But the simple understanding of how your business's value is this. Most buyers are going to calculate your business based on the trailing 12 months profitability that you have, using a term called the EBITDA, or seller's discretionary earnings, or SDE. And then they're going to apply something called a multiple to that. And that's going to create something called your enterprise value. So I've got $250,000 worth of profit. I'm selling my business for a 4x multiple. That means that the enterprise value of my company is 250 times 4, or $1 million. Now, I'm just using that as an example. And then what they're going to do is they're going to do something called a balance sheet adjustment. And they're going to say, in addition to the $1 million, if you've built up $200,000 worth of assets, inventory or cash or those types of things, that gets added on to the purchase price minus any money that you might owe. So that's the basics of how things are valued. And then there's a much more advanced way I'll talk about here, but I want to at least kind of stop there and make sure that everybody understands. That's kind of like, I always call it's the way that it's calculated. We'll find out here in part two that it's not always the way that it's valued.
Absolutely. Yeah. So before to go into the advanced way, which I think is going to be, the main topic today, I just had a follow-up question based on what you mentioned, because you mentioned obviously that we need to build things in a way that will be appealing to the buyer, right? So what I'm thinking about is, should we know who the buyer is going to be before, during our strategy sessions, during our planning, and then, kind of crafting everything for that kind of buyer, or do you think there is just a general way that will appeal all kinds of buyers, and that's the only way we should go about it. So
yeah, that's a great. It's a great topic. Here's the way that I think about it. You don't have to know your buyer by name, but you probably want to know the different buyer categories. And here's what I mean by that. One of the buyer categories, I'm going to call it the aggregator categories. Okay. And, there's a number of names out there that people are familiar with. And I won't say any one over the other, but there's 60 or 70 different aggregators out there now. And they typically want to buy 100% of your company. They may want to keep you around for some period of time, but then they do want to take over the business themselves, and they generally structure their payment structure so that you'll get a percentage in cash, and then you'll get a percentage in what's called a stabilization payment, and maybe a percentage in what's called an earnout, depending on how the business does. So I think as a seller, it's very good for you to understand that as what I call a buyer lane or a type of buyer, because there's actually a different type of buyer out there called a private equity or a growth equity buyer. And what they want to do is they don't want you to leave. What a private equity buyer wants to do is they want to invest in your business, and maybe they'll buy half of the business or 60% of it now. They'll let you keep 40% of the business, and then you'll continue to grow that company, and you'll actually stay on with that company for maybe 2, 3, 4 years, continuing to grow it. And for a lot of people, they'll say, oh, I don't know that I'd like that. But for other people, if they had the opportunity to have all of the cash that they could ever need to grow the business, and they had a really impressive brand, they just don't want to keep up with the demands on the cash that it requires to grow it. It can be a great exit. So the way to think about that is that you should know, and there's really 6 different types of buyer categories that we can get into. But the most important thing is to understand is that there are different buyer types, and that's not only typed by category, but also by types of products and things that they're interested in. And it's very good for you to do some research on the different buyer types, and then not worry so much about the name that happens to be in that type.
Right. Okay, makes sense. So are you suggesting we should, or at least try to optimize things for one or a few categories of buyers? Is that something that you think it's possible? Are there different actions that we can do in that regard?
Yeah, the good news is that 80 to 90% of the actions that you take, I always like to use the statements, what's good for selling a business is good for running a business. And so most of the things that you're going to focus on, the value levers are going to be similar. And here's where we get to the more advanced concepts of valuation. Most people look at the valuation as the trailing earnings times the multiple, and it gives me the valuation. Well, there's 2 really critical things to understand. That's how your business is calculated, but that's not how it's valued. And what I mean by that is calculated would say that something's in Fahrenheit or Celsius, but it doesn't tell me how hot it is. Okay. And I'll use my example. If I have that business that's $250,000, it's a 4 multiple and it's worth $1 million. If I have 2 businesses and one of them is growing at 70% per year and the other one is growing at 5% per year, and they have the exact same $250,000 worth of historical earnings, are they going to be valued differently? And the answer is, of course they are. And this gets to the advanced understanding, which is that what a buyer only cares about is they care about what their effective multiple is. So if they buy a business for $1 million and the profitability doubles in a year, they didn't pay a 4 times multiple for that business, because in a year it's making $500,000 and they bought it for $1 million. Their buyer effective multiple went down to a 2 from a 4. Whereas if I bought a business that was flat and never changed, the multiple that they're paying is a 4. So it's very important to understand is that most people think about what they're selling. And one of the other core sentences I always want people to think about is it's not what the seller is selling, it's what the buyer is buying. And you want to be thinking about, when you're trying to maximize the value of your business, what is the story or what is the potential that I'm selling? Because a buyer is not buying your historical earnings. And the reason they're not buying your historical earnings is because they don't get to keep any of that. Whatever money that you have in the company that was profitable, that you either spent that on the trip to Las Vegas or you left it in the company, and they're not going to see a dime of it. The only money that a buyer ever sees is the future dollars after they own it. Therefore, the only dollars that matter to them is the future profitability. They're using the historical profitability to give some indication of the future, and they might be using the historical profitability as a way to keep the number low, because if your business is growing, right, why not use the last 12 months rather than the next 12 months? So you'll have a lot of buyers that say, oh, we don't buy based on future capabilities. But the reality is every buyer only buys based on your future capabilities of your business. Once you think about that and really lock that into your mind, a whole different way of thinking about the worth of your company changes, because you realize that in order to get the maximum value for your company, you're selling the secure, stable future of your business, not just what it's achieved in the past. Does that make sense?
Yeah, awesome. I love that. Actually, I've heard already from you previously, and I think it's a very, very smart concept and a big shift in mindset. I think every seller should start to have. Also, because I'm thinking, whenever you're saying that, I think that a sale of a business, it's something. It's a private sale, right? So it's basically an agreement between two people. So whatever it's worth for that person, it's there are reason behind that. There is not always just math. For example, if somebody there is another buyer, for example, that has a huge connection with like a very big connection or close connection with Walmart, for example, and they know for sure that they're going to take your product in Walmart, for example. That's worth way more for them because they are able to grow it much faster than anybody else, right? So the value for them, it's going to grow much higher, right? It's for them, it's much higher than it actually might be, the ones that you calculate through the normal ways, let's call it, right? So I think it's a very interesting shift of mindset on how to calculate value, distinguish it between the price and the value. I think that's the main shift we need to have.
Yes, absolutely. Yeah. Yep. And it starts to get you thinking about the future. For example, one of the most obvious ones is a lot of people say, well, if I'm about to exit my business, should I stop adding new products and try and maximize my profitability? But then what I always come back to people is saying is that for most businesses, they're buying the future potential. And so if they're trying to buy a business that has 10 products in it, and every one of them have been out for a year, and there's no innovation and no new products coming out in the pipeline, and every one of those businesses or products is already ranked at the top of Amazon, what is likely going to happen to the growth of that company? Is there any way that it can grow, or more likely the earnings next year are going to be less? Because there's no place to go. You can't go up if you're already at the top. So the only place you can go is down. And so if you don't have new products in the pipeline that are part of that exciting story, you might have maximized, and maybe you're making a little bit more earnings this year, but the multiple you're going to get on that business is going to be much lower because a buyer can't see any growth potential and they're buying the future growth. And so you have, rather than selling, you may have gone up from 250,000 of profit to 300,000, but if your multiple went from a 4 multiple down to a 3 multiple, 250 times 4 is $1 million, 300 times 3 is 900,000. You can actually make your business more profitable but less valuable if you do things like slow down the growth of the company too much. More importantly, it might be harder to sell it at all because a buyer might just not see any future potential in that business.
Yeah, that's very interesting. Since you're talking about multiples, let's give more clarity, because I think many people have doubts about that or misconceptions. Who's deciding the multiple at the exit? And tell us more about like how we can influence that. Not influence, but I mean, first we'll cover in a bit like the value drivers, but let's talk about the multiple. Who's setting that multiple?
Yeah. So the easiest way to think about the multiple that I've always found is it's based on what the expected yield or return is for the buyer divided by how much risk they perceive in the business. So whether I set it as your advisor to a buyer and I say you have to pay a 4 multiple for this business or we won't sell, or they come to me and they offer a 4 multiple, the key point is this. If a buyer needs to earn, 30 to 40% per year on their investments, and they pay a 4 multiple for something that is flat, that's not growing. If I pay $1 million for something that makes $250,000 a year for the rest of time, I've got a 25% return on that particular business. So the important thing is that your multiple is going to determine what the profitability is, and the more that you can show that the profitability is increasing, the higher the multiple can be, because the buyer is still going to earn a yield, is what they refer to it, or we might call it a return on investment. And then the other key thing is to recognize that a buyer always looks at the yield divided by the risk. Most people think that the number one thing they need to do to increase the multiple is to drive up more good things. What I always like to say is the number one thing that a buyer wants to understand first isn't the good things. They want to know that there's no bad things that can happen. So, they want to know that your products are compliant, your trademarks are in order. They want to understand that you've not used black hat tactics to optimize all of the things. So when you go out to try and sell your business to a buyer, most people try and sell how great it is and get so excited about it, which is important. But the other thing is just if you put yourself in the buyer's shoes, the first thing you want to do is to get them to understand that this is a very stable business. There's very little risk in this business compared to other businesses, and that will actually help you increase your multiple, because it's always the yield divided by the risk. It's a very, very critical concept to understand.
Yeah, that's actually very, very helpful, I think, for people to clarify this concept, because I think multiples has been something like people are asking around, like, what's the multiple now? I always hear this kind of question. Yeah. And I think you just put it very well with this kind of formula, like ROI or yield, the return on investment over the risk, or the perceived risk, right? So, yes. So basically, yeah, go ahead.
Yeah, no, and it brings up a great point. Sorry to cut you off there, but most people will hear a statement. Somebody will say, "Oh, it's not a good time to sell your company right now because the multiples are bad." And the way I always think about that is that that's a very simplistic way of thinking about it, and I encourage people to be much more sophisticated. Number one, by the time that you get ready for exit, you don't know where the multiples are going to be. So, if I want to sell my business today, I might be selling it in 6 to 12 months from now. So that there's a time period there. But more importantly, 80% of the value of your company is not based on what generally is going on with multiples. It's what's going on with you. So I call it the micro versus the macro factors. So the macro factors right now is that interest rates are higher and consumer demand is slower. So that means that buyers can't afford to pay what they could have 18 months ago. But more importantly, if you have a business right now that is profitable and it's growing and it's diversified, a lot of your other, I'll call it other sellers, don't have that business. They've struggled. So you actually look more unique now than what you did when everybody had a good business. So it's very oversimplistic to say, oh, it's a good time or it's not a good time. There's only, is it a good time for me? And is it not a good time for me? because that's the 80-20 rule of it. Now, what goes into that is a number of different factors, but it's very oversimplistic and frankly inaccurate. We have buyers right now that are contacting us every week asking for good companies to buy because it's harder to find them, and they still have, and remember, there's 12 to 15 billion dollars that came into this industry to buy things. That money's still there to buy things. They just have fewer and fewer things that meet their criteria. So if you can meet their criteria, you could arguably be as valuable or more valuable than what it was 12 to 18 months. So get out of the mindset that there's good and bad in general, and get into the mindset that there's a right time for my company, and I need to learn enough to know when is that time for my company.
Wow. Okay. That's really important for you guys to understand this concept. So I suggest you to push the button to go 30 seconds, a minute back and listen again what Scott just shared, because this is a very important thing. So you should focus on your company, what you are doing, your performance, not the market performance, because as Scott just shared, in good times, it's good for everybody. So you might be one of the many and get maybe a lower multiple because you're just one of the like everybody else. But if you have actually a better company, a better business than everybody else because of market conditions, maybe you might get even better multiples or just a better exit because you are more unique in the eyes of the buyer. Am I understanding it right?
Yep, that's exactly it. Yes.
Okay, awesome. So I want to get back to what we were talking about before. So let's get more clarity on how do we assess the current value, so that then we can start building a forecast with the numbers on how will we get there. Okay, so we're starting from the goal that we said in the first phase. So now how do we assess the value and then build a forecast to get to that target exit?
Yes. So this is something that we put in that workbook. It's called the Lifetime Business Value Tracker. And what it does is it allows you think of it as in like the right column, you fill out where you want to exit. And what it'll do is you'll fill out what my revenue needs to be, what my profitability is, an expectation of my multiple, and then it'll fill out what taxes do I have to pay. So you can line that up and go, okay, this is when I'm going to exit. Then in the far left column, you put where am I at today? And almost always what you're going to have is a gap between what you are worth today and what you want to be worth. And I liken it, the picture I put in your mind is when you see those fundraising things that have the thermometers, right? And the goal is the top of the thermometer and I'm at the bottom. And your goal is to continue to improve the business. And what I recommend that you do is lay out a very simple forecast initially in the next 90 days, 180 days, 360, and then whatever 2-3 years, depending on how long your exit journey is. What are realistic numbers that I can just see on one simple sheet that I would go, I think I can hit those numbers, and then what would the resulting value look like if I did? Now, every time that you do a forecast, it should be more accurate and more sophisticated than your first one. But a lot of times people start out and they go, wow, I need to get it so sophisticated that they never start. Okay. And so the answer to that is the first thing that you do is you implement this, what's called Lifetime Business Value Tracker. And then you lay out the particular forecast of what it would take in order to hit to your goal. And you can use that chart before that said, if I'm going to hit 30 products released and 20 of them are going to go there, I'll get to my goal. All you're doing is saying, well, if I got to do 30 products over 3 years, I'm probably not going to do 10 each year, because maybe my first year I'm only going to do 5 because I'm just getting going. And I'm just understanding it. So it might have to be 5 and then 10 and then 12, or you might realize it might take me 4 years. The important point is that you've now set a runway ramp for where you're at today to then where you're going to be when you hit your goal, and you'll have one sheet to do it. And then it'll actually create the lifetime business value graph that'll show you how much money you're going to get from running a company and exiting it. So that is really step one. And then step Step two is to go into each one of your particular products and build what's called a bottoms-up product forecast, where you actually look at each of the products that you're released already, and you basically say, okay, this is how much profitability I can expect from these products. Then you have your second category, which is new products that you know that you have that are coming out to the market. And then the third one, you won't know the name of the product, but you're going to have to list, product 6, product 7, just list it generically and list the metrics of what you're planning on releasing. So if I'm in the health and beauty niche and I want to release 15 products that are all going to be worth $25 to $30, you literally list them out, and then you'll get to see over time, these are the products and the profitability, and then that can lead to your lifetime business value goal. So always start with what's called a top-down budget first, just estimating it out, then go look at the number of products and build what's called a bottom-up budget of how many products do I need to release, and then we'll talk about what's the definition of a successful product. But once you build that, you now have a chart in front of you that links your valuation today to your valuation over time.
Awesome. Okay, I'm going to add something to that because I love this whole conversation. Tell us what makes a successful product, since you just introduced it.
So when you think about what a buyer values, remember, it's not what the seller is selling, it's what the buyer is buying. I call it, again, the 20-20-20 rule, because it allows people 20-20 vision is what I always think of it as. If you can have, the number one thing you need to have is you need to have profitability in your products. And the definition of profitability is generally around 20% profit after overhead, or 25 to 30% contribution margin. And contribution margin is simply the revenue, the net revenue. So revenue minus any refunds, minus your product costs, minus your Amazon fees, minus your paid media expenses. So on a percentage basis, if I'm selling a product, if I sell $100 in products, and I'll ignore the refunds for right now, $100 in products, if I have $25 that those products cost me, that's a 25% cost of my product. So I'd have a 75% margin, what's called CM1. If I have another 40% in Amazon fees, then I've got a 35% margin. And if I have 10% in paid media, I have a 25% contribution margin. So that's the number one thing, is you got to focus on that profit margin. The second thing you want to focus on is your growth rate, and you need to be growing to be valuable at a minimum of 20% per year. So if I'm 20% profitable and I'm growing at 20% per year, then my next 20% is what is called your risk or your diversification. I don't want to have any more than 20% of my revenue tied up in any one product. And the reason is because if that product goes down, there's a big loss of revenue to the company. And so the buyer is going to perceive that as risk, and you're not going to get a premium valuation. And then the fourth pillar is just the size of your earnings. If you can achieve 20% profit, 20% growth, and not have any more product with 20% of your revenue, then if you have $500,000 of earnings or $1 million of earnings, the bigger your earnings, the more options that you'll have for exit. But a company that has more earnings that doesn't have those types of growth metrics might actually be worth less of a multiple than somebody that is smaller that has higher growth. So those are the main drivers that you should think about. And now if I relate that down to a product, if every product that I have, if my overall profitability needs to be 25% contribution margin, but the first 3 products I released only have 15% contribution margin, then I just need to understand why. If it's that they're in launch mode and I'm not quite there, okay, that can be acceptable. But if they've been out there and I'm on the yo-yo of every time I drop the price, I can get the ranking, but I can never get more than 15% contribution margin. If I can't fix that product, then my goal is to launch new products that get me to that overall average. So it's just a process or analytical way of breaking down what's going on. And as I always like to say, not get too emotional about any one product, but to recognize that your success as an exit is on the ability to prove that you can continually release products that are successful, and you have to define that success and then stick to that in terms of that 20-20-20% model.
Awesome. Okay. You just unpacked a lot of information. I think it's really, really valuable. You guys can find, all these the steps that Scott just shared in the exit workbook that we're sharing with you in this mini series. So you can go in each of the episode of this mini series, find the show notes or the description of the YouTube video. And you will see a link where you can download this exit workbook, which is a massive, super professional workbook where you will basically go step by step through all the processes that we're describing in these episodes, and do everything that we've been just covering. But something that I really want to stress here, which you mentioned, Scott, is the importance of the financial model and forecasting your business and creating forecasts for your business. This is something I think I learned way back in my first business, and I think it's a super valuable thing. So I just want to kind of simplified in the most simple terms, because also I like to it's a way for me to learn it, and for hopefully for people to understand it better, just in different terms. So basically, whenever you set a goal, there is going to be a gap between your goal and your current situation. So then you need to understand how you're going to fill up that gap. Okay. And in this case, you need to understand what are the value drivers of a business. In this case, we're talking about an Amazon business. So the value drivers are going to come from products. Okay. So basically selling more of the same products or selling new products. Right. So this is the only two ways you can increase sales. Basically, then you should refer to all these metrics that Scott just shared. So 25 to 30% contribution margin, which we can call it even gross profit. I think some people call it gross profit, and 20% growth year over year, at least to put yourself in the right path for a successful exit. So guys, think in terms of how do you feel the gap between where you are to where you want to go, in terms of like how many of the current products that you already have you need to sell, and how many new products you need to launch. And that's gonna give you, like a number of how long it's gonna take, or how many products you will need to launch or sell in order to get to that target number. So that's how you eat an elephant, one bite at a time, right? Is there anything you want to add before we close? Because I think we've covered a lot, and we will cover more in the next episode as well.
The only thing that I would like to cover in this one is sometimes numbers can feel anxiety or not fun or those types of things. But what I always like to say is building a forecast toward your exit is the most fun numbers you'll ever experience, because it's building the plan towards something that will be life-changing for you. So we built the workbook to make it as simple as possible. But if it's confusing the first time and you stick at it, you will learn it. But think of it as forecasting as an exciting process, because it's really mapping out your future. Going back to that owner goal from number one is, if I want to get to a point to where I am a successful entrepreneur, this is the blueprint that allows me to do it. It's very empowering. And I've seen so many sellers that we have helped exit for millions or even tens of millions of dollars go from not wanting to do it to enjoying the process of doing it because of the clarity that it gives them, and then the excitement when they get that big check. So that'd be the last thing I would say is, if it's frustrating initially, stick with it and it will get better. And this is the fun part of accounting, if you want to call it that, the fun part of numbers, because it's numbers that show you the path to your goal.
Absolutely. 100% agree. It's going to give you so much more clarity. So guys, remember to download that workbook. Where people can find you if they would like to reach out or learn more about you.
Sure. Very simply, if you want to reach me individually, if you're thinking about an exit or if you have any questions, it's my first name, Scott, at northboundgroup.com. And so it's all together, northboundgroup.com, and just my first name or go to our website at northboundgroup.com.
Awesome. Okay, guys, remember the key to success is to emulate the best. So take action on the tips that Scott just shared with us. Remember to download the exit workbook and stay tuned for the next episode. That is gonna be the last episode of this mini series. It's gonna happen soon. Have a productive week in the meantime, and I'll see you soon. Hey entrepreneurs, I hope you enjoyed the episode and learned something from the interview. If you're serious about creating systems for your business, automating processes and building up your team so that you can transfer the tedious daily tasks in order to focus on more high-level strategic tasks and work on your business and not in your business, I've created a guide for Amazon sellers named Capturing Systems and Creating SOPs that you can find at thesellerprocess.com/systems ebook, where you will learn how to leverage systems and SOPs in your Amazon business so that you can accomplish more by working less, optimize your time, automate and delegate tasks, and reap the benefits of being a true business owner and not simply an operator in your own business. Go download the ebook at thesellerprocess.com/systems ebook and start implementing all the tips and insights that I share with you. And leave us a review or a comment to let us know how the content we are sharing here is making an impact in your business. And have a productive week.